So let me ask you a question. How much of the wealth you've worked so hard to build is truly under your control? It's a pretty intense question, right? But it gets right to the heart of what we're talking about today, financial sovereignty. We're going to break down a complete framework for protecting your assets from forces that can feel totally out of your hands, things like government policy and wild market swings. We'll get into everything, from the mindset of the wealthy to the exact legal structures they use to build a financial fortress. All right, let's jump right in. Our sources kick things off with this really powerful phrase, financial tyranny. Now, when you hear that, don't picture some cartoon villain. Think of it as a system where huge institutions can basically manipulate the entire economic game, making the money you saved worth less and less over time, or just changing the rules on you without asking. This really sets the stage for the core conflict we're exploring, your personal quest for financial freedom versus the systems that want to control your money.
And that really boils down to the single most important question we're going to tackle. If you get right down to it, who's actually in the driver's seat of your financial life? Is it you? Is it your boss? Is it the government through taxes? Or is it central banks deciding what your dollar is worth? The sources argue that if you want to protect your wealth, you first have to get brutally honest about who's holding the keys.
To figure that out, we have to map out the terrain. The sources describe it as an invisible financial battlefield. It's not a physical place, but a constant tug of war. You've got these massive forces on one side, government policies, central bank actions, and on the other side, there's you and your personal financial decisions. It's a battle where these huge, macro-level shifts can directly impact your wallet.
Okay, this slide makes a really critical distinction. On one hand, you have fiscal policy. This is what the government you elect controls, how much they tax you and how they spend that money. Pretty straightforward. But then, on the other hand, you have monetary policy. This is control over the money itself, the printing presses, interest rates, the whole nine yards. And here's the kicker our sources emphasize. In the US, this isn't controlled by the government. It's controlled by the Federal Reserve, which they describe as a private bank. So think about that. You've got two different powerful entities, both with their hands on these massive levers that control your financial world.
All right, so now that we know who has control, let's look at how they do it. What's in their toolbox? This isn't just some abstract theory. The sources point to very specific, very real mechanisms that are used to steer and sometimes just take wealth from people like you and me.
The sources basically lay out four main tools. First up, the most obvious one, direct taxation. Income tax, property tax, the government taking its cut right off the top. The second tool is way more subtle and, honestly, way more dangerous. Money printing and inflation. When central banks just create more money out of thin air, every single dollar you've saved loses a little bit of its value. It's like a stealth tax. Third is asset confiscation, which sounds crazy, but as we're about to see, it has happened. And finally, regulation and reporting mandates, which basically gives the government a giant magnifying glass to look at everything you do financially.
Okay, now this is a pretty wild idea from the sources, but stick with me. Why does a dollar bill have any value at all? I mean, it's not backed by gold anymore. The argument here is that its value comes from coercion. You have to get dollars to pay your taxes. What happens if you don't? Well, you go to jail. That threat, the threat of losing your freedom, is what creates a constant forced demand for the currency. That demand is what gives it value. It's a pretty mind-bending concept.
And if you think the rules are set in stone, this timeline is a serious reality check. This isn't just theory. Back in 1933, the US government literally made it illegal for regular people to own gold, and then they confiscated it. Now, let's fast forward to the very near future. Starting in 2026, a new international rule called CARF is coming into effect. It's going to force crypto exchanges in over 75 countries to automatically hand over all your transaction data to the taxman. The point the sources are making is crystal clear. Whether it's shiny rocks 100 years ago or digital code today, governments will always change the rules to keep control.
Okay, so we've laid out the threats, and I get it, it can feel a little daunting. But here's where the script completely flips. The sources don't just dwell on the problem, they're all about the solution. And their number one argument is that your best defense isn't some fancy investment product, it's something you have complete control over. A rock-solid personal financial policy.
I mean, just let that sink in. This idea gets repeated over and over again in the source material. No government program, no stimulus check, no tax break is powerful enough to save you from a bad personal financial plan. It's a huge shift in perspective. It means that the rules you set for yourself, for your own money, are actually more powerful than the policies set by politicians. Your personal policy trumps public policy, period.
So how do you even start building that personal policy? Well, the source material points to Robert Kiyosaki's cash flow quadrant as a great starting point. It's simple. On the left side, you've got E for employee and S for self-employed. If you're over there, you're trading your time for money. If you don't work, you don't get paid. But on the right side, you have B for business owner and I for investor. Over here, you build systems and buy assets that make money for you even when you're not working. The key takeaway isn't about quitting your job tomorrow, it's about shifting your entire mindset from the left side of this quadrant to the right.
And that really gets to the heart of the rich dad, poor dad philosophy. The poor dad mindset is all about seeking security from the system. Get a safe job, hope for pay raises, and trust that your 401k and Social Security will be there for you. The source calls this an entitlement-focused way of thinking. But the rich dad mindset is the total opposite. It's control-focused. It's about building your own system. You focus on buying assets that put money in your pocket, you avoid liabilities that take money out, and you take control of your own financial future.
Okay, so you've got the right mindset. Now what? Well, you need the right tools. And the sources are incredibly clear on this. Risk management is, without a doubt, the most important part of investing. It's not about chasing the latest hot stock or trying to get the highest return. It's about playing defense first. It's about building a portfolio that's tough enough to survive all those threats we talked about earlier.
And the guiding principle behind it all is actually beautifully simple. Control what you can and hedge what you can't. Think about it. There are things in your financial life you have direct control over and things you have absolutely zero control over. So the strategy is simple. For the stuff you can control, like how much you spend, what you invest in, when you sell, you exert maximum discipline. But for those huge, scary, uncontrollable risks, like a government suddenly changing the rules or a massive market crash, you need a totally different strategy. That's where you hedge.
This table just lays it out perfectly. Let's walk through it. Take sovereign risk. That's the risk a government pulls a fast one and changes the law. Can you control that? No. So what do? You hedge. What about systemic risk, like the whole global market just imploding? Can you control that? Nope. So you insure or hedge. But now look at the bottom one, personal risk. Making a bad investment, getting greedy, holding on too long. Can you control that? Yes, absolutely. And that's where you use strategies like having a clear exit plan before you invest, or sizing your position so that one bad bet can't possibly wipe you out.
So what in the world is hedging anyway? The sources use a great analogy. It's basically like buying insurance for your portfolio. Simple as that. You own a house, you buy fire insurance, right? You don't buy it because you want your house to burn down. You buy it for protection in case it does. A hedge works the same way. It's an investment you make that's designed to go up when your other investments are going down. It's a purely defensive play. And the sources point out that even billionaires like Mark Cuban use these exact strategies to protect their fortunes.
So what's in this toolkit of insurance policies? Well, the source material points to a few key ones. You've got complex financial instruments, like options, which can act as direct insurance on your stock portfolio. Then you have the classics, physical gold and silver. They've been a store of value for thousands of years, and they tend to do really well when governments are printing tons of money. The sources also bring up newer assets, like Bitcoin, as a potential hedge against that very same money printing. And of course, there's good old tangible real estate, which gives you cash flow and can protect you from inflation.
But look, just owning the right assets is only half the battle. If they're not held correctly, they're still totally vulnerable. This is why the sources stress the importance of the legal structure you build around your wealth. This is where we move from just being an investor to being a financial architect, creating a fortress with legal entities that act like impenetrable walls against things like lawsuits and creditors.
Asset protection attorney Gov't Sutton, who is one of the sources, has its great quote. He says a corporation is just a legal document that creates a legal body without a soul. It's not a building, it's not a team of people, it's just a concept on paper. And that's what makes it so powerful. This legal person is totally separate from you. It can own things, it can get sued, and here's the best part. It often gets taxed at a lower rate than an individual. It's the first wall of your fortress.
Now this is where the strategy gets really clever. It's not just about having one company. It's about creating layers of protection, like an onion. Let me break it down. Step 1. You've got an asset, let's say a rental property. You put that property inside its own limited liability company, an LLC. The LLC owns it now, not you personally. Step 2. To protect your ownership of that first LLC, you create a second LLC, but you form this one in a state with amazing asset protection laws, like Wyoming or Nevada. This second LLC's only job is to own the first one. Step 3. What you're left with is this multi-layered structure that puts a ton of legal distance between you, the person, and your valuable asset.
So you might be thinking, that sounds like a lot of work. Why bother? Well, the reasons are incredibly powerful. First, it separates you from the asset. If a tenant slips and falls and sues the LLC that owns the house, the lawsuit stops there. It can't jump over to your personal bank account. Second, if someone wants to attack the ownership of the company, they can't sue you in your local courthouse. They have to fly to Wyoming or Nevada and try to fight you there under their laws, which are way more friendly to business owners. The sources say this creates a very uphill battle for anyone trying to sue you, which makes you a much less attractive target in the first place.
Whew. Okay, we have covered a ton of ground, haven't we? We've gone from huge global monetary policies all the way down to the nitty-gritty of legal paperwork. So now let's put all the pieces together into one complete framework. This is the path from just being a player in the system to achieving what the sources call true financial sovereignty.
So here it is, the complete blueprint, the multi-layered defense system for your wealth. It all starts with step 1, the foundation of everything, adopting that rich dad mindset that's obsessed with control and owning assets. From there, you move to step 2, where you build your own personal policy, your non-negotiable rules of the road for your money. Step 3 is when you equip your fortress with the right toolkit, mastering risk management and knowing what to control and what to hedge. And finally, step 4, you build the walls high by creating those protective legal structures. See how each step builds on the one before it? It's a complete, logical system.
And that leaves us with this one last really powerful idea from the sources. They argue that true wealth isn't about the number in your bank account. It's about resilience. It's not about what you own, but what is structured in a way that it can't be easily taken from you. So, after all of this, it forces us all to look at our own lives and ask a tough question. What part of my financial world is a fortress that I built and I control? And what part is just a house of cards exposed to the whims of everyone else? Definitely something to think about.